This is the second video in a series that looks at how I would invest $100 if I had to start over. The goal of this series is to identify the key investor traps that we all face and how to counter them step by step. While I'm going through some very basic mechanics, understand that the real value of this information is in reminding ourselves of the many ways our mind can sabotage our financial security. This video applies to all investors from beginners to the experienced. We are all in the same boat. We are all vulnerable to these errors. And a quick request, please give this video a like and consider subscribing. It's free and it helps this channel reach other investors. To recap the first video in this series, we weighed the differences between being a trader and being an investor. We decided that being an investor was the better path, but we still wanted to go with the easiest and safest route to building wealth. And we didn't want to be wrong in our evaluation of a single stock. We didn't want to keep up with the financial details of a single company. We didn't want to watch the market go up as our individual stock went down. And based on these criteria, we decided to invest in the entire stock market rather than pick individual stocks. We decided to invest in a broad market exchange traded fund, or ETF, perhaps the Vanguard Total Market Index ETF, ticker symbol VTI. In this second video of this series, I'm going to walk through how I plan to invest that $100. First, I'm going to open up a taxable non-retirement individual brokerage account at Charles Schwab. And FYI, Schwab is not sponsoring this video. I'm using Schwab as an example because they're a full-service discount brokerage that has all the services you'll need as you build wealth. Opening the account at Schwab is simple. It's a simple online process. It takes about 10 minutes. I'll need my Social Security number, and there is no account minimum. I'm also going to link my checking account to fund my brokerage account. Okay. I've set up my account, funded it, and want to buy an ETF such as Vanguard's Total Market Index, like a VTI. But I see that the current price is $340. What am I going to do? I only have $100 to invest. Do I wait until I get the $340? No worries at all. I decide to go with a mutual fund, which allows me to buy any dollar amount. Another difference is that mutual funds, unlike ETFs, usually trade once a day after the market closes. So I select Schwab's Total Market Index Fund, ticker symbol SWTSX, because it's similar to Vanguard's VTI ETF, and it also has low management fees at 0.03%. We now encounter a trap that has done much damage to limiting wealth accumulation, and it's worrying about a market top. By the way, when I talk about the market, I'm referring to the S&P 500, which is a good proxy for the stock market. And there are other markets out there, such as the bond and commodities markets, but that's a topic for another day. And as I record this video, it's February 2nd, 2026. I recently read an article that said the S&P was projected to underperform for the next decade. So I'm entering a stock market that is currently considered overpriced. And I've heard something about you need to buy low and sell high. So should I be concerned? Well, should I try to time the market? This is a perennial concern. The stock market may very well be overpriced, but it can stay that way for years. So for me, I'll ignore market conditions and choose to invest consistently each month. And I have data on my side. Over the last 100 years, the stock market has moved higher. Since 1926, the S&P has delivered an average annual return of approximately 10.4%. Now, zoom in closer, and we see a lot of scary drops, but the overall direction is up. This is what it means to be in the right church. So the first significant trap we must learn to overcome is the fear of buying into a market top. And there are ways to mitigate this risk of underperformance. First, we'll be investing each month, which allows for dollar cost averaging. There will be times when we can buy at a lower price, and there'll be times when we'll be buying at a higher price. Second, we'll invest the dividends into more stock. And this counters the effect of underperformance as you're also creating a compounding effect on your principal. And it's important to know that each of these accounts at brokerages like Charles Schwab, you can set it up for the dividend reinvestment program. And you do want to have that set up where those dividends are automatically going back to buying more shares. And you also, third, what you want to do is you want to automate your contribution. So I'm going to be automating it so that every month money gets taken out of my checking account to buy more stock, more of that mutual fund. And it's a principle, it's called pay yourself first principle. And that principle is very important. You want to contribute to your future self, to your well-being first before you pay any other bills. Fourth, I'm going to look for ways to cut expenses and earn extra money to increase my contributions. So you take all of those actions together. What we've done is we've created a process that is scalable. To summarize, even if the market returns are lower, it's the process, the dollar cost averaging, the dividend reinvestments, and so forth that build the wealth. And the fourth reason really gets to the heart of the matter is that actions that increase contributions accelerate the rate of wealth accumulation because it's improving two important income statement elements at the same time. I'm both lowering my operating expenses and I'm increasing my revenue. So I propose to you that you think of yourself as a business. The goal, like any well-run business, is to have low debt and high profit margin and to expand your revenues. And you do all that by cutting expenses, looking for ways to bring in more money and diverting those profits that you have after expenses into buying more of the stock mutual fund. Once you've automated your system to handle the market tops and bottoms, the only thing left is to manage your own timeline. This introduces another trap that we need to recognize and manage, and that's impatience. In the early years, and it does take years, there'll be times when you see losses in your portfolio or little improvement in your account. And you'll hear from others, maybe on television or on the internet, who's saying how much money they're making in this and that stock. And this is where we need to talk about having a financial plan and sticking with it. As part of investing this $100, I created a financial plan that included how I would invest. And importantly, the reason why am I investing in the first place? Reasons could be I want to have a secure retirement, I want to save up to purchase a house, or I just want the peace of mind that comes with having a margin of safety. And this last point, I think, is probably the most important. And it's that there's an important shift that happens once you realize that you have sufficient money to live on for a year or more. This allows you breathing room to not stress about your job, not stress whether markets dropped, not stress about a major repair that's needed on your car. So I personally, for me, I keep 3 years of living expenses in money markets, and I keep about 3 months of living expenses in my checking account. Even though I don't have any debt, it just gives me peace of mind. To recap, we need a reason why. Why are you investing in the first place? So you don't get tempted by these more accelerated claims of wealth. Another trap to be worried about that's related to impatience is that of infatuation with complexity. And you may hear others talk about how using options and other strategies to juice their returns, and they've been very successful with that. And what does this sound like? This sounds a lot like trading, and we decided at the very beginning of this process that we're not going to be traders, we're going to be investors. So again, go back to your financial plan and reaffirm why you are investing in the first place. And the reason I decided to invest in the market instead of individual securities is I wanted to avoid the heavy lifting of keeping up with financial analysis of each of those companies. And there's another saying that is embraced by many older investors, and that is your brokerage account is like soap. The more you handle it, the smaller it gets. That's a warning that the more you get in there and fiddle with your account, the more you are at risk of it going in the opposite direction that you want. So to recap, the traps that we discussed are worrying about market tops. The solution to that is your dollar cost averaging, your dividend reinvestment program that you set up, your automatic contributions. Impatience is another trap. The solution, again, is to have a financial plan and follow it. The plan needs to have your reason why you're investing in the first place. The next trap is infatuation with complexity. We love complexity, at least some of us do, but that really works against us. So the solution, again, is to go back, do your financial plan. Remember that the goal is to manage risk while allowing the market to do the heavy lifting. Don't treat your brokerage account like soap. That is the bottom line. In the next video, what we're going to do is we're going to address the topic of asset allocation and look more closely at risk management. Thanks for watching.